So you brought up mortgages and you brought up properties, right? I'm interested in that. So say if like I live in California and I want to go to an owner-friendly state, right? There's a more specific term, right? I know there's tenant-friendly, but then there's also, not renter, but like the
landlord-friendly states.
There we go, landlord-friendly. So like one would be, how would I go about that? Say if I want to purchase, do like a flip, or may possibly just get one property just to fix up a little bit and just keep.
Okay, cool.
Right.
So if you're trying to get a property in a landlord-friendly state, I personally like Florida and Texas. That's where I own a majority of my real estate, landlord-friendly states. So most of my properties are not in HOA communities. I can kind of do what I want with these properties.
Yeah. Nice.
But the first thing is coming to terms with the down payment. I think once you can get that out the way mentally, like saving money, because that's the hardest thing for most people to do is just save money and be disciplined enough to save, and realizing, okay, that money is going to leave my bank account once I've saved enough. That part, once you get that mental part out of the way, then it's about connecting with the right people that can put the deal in front of you. Because most people are going to jump on Redfin. They're going to jump on Trulia and Zulia and every other, realtor, website. And they're going to think all of a sudden that they're an expert because of what they see. We all go to the grocery store, we buy things that we like. We all go to the mall and we buy things that we like. When it comes to real estate, it's not just about seeing what you like on the website and saying, okay, let's go for it. It's about numbers and figuring out how is this going to serve me not only right now, but in the next 10, 15, 20 years, depending on what type of investor you are. If you're a flipper, that's an active business. That's not a passive business. So that comes with completely different terms and completely different entity structures. But most people who are going into real estate, they want to do it somewhat passive. They want to earn cash flow, have a tenant pay down their principal, their mortgage, and then reap the benefits of being able to scale an investment portfolio. So if you're looking for that, then the best thing that you could possibly do is to buy an investment property that's also going to reduce your ordinary income, because that's how you're going to get to retirement faster. You're being taxed on your ordinary income, your LLC income, your S corporation income, or your W-2 income the most. When most people look down at their paychecks and they're looking for cash flow, could you imagine that every single W-2 paycheck that you had, you were getting 100% of that money? Not 25% of what you were supposed to get or 50% of what you're supposed to get. You get 100%, the IRS gets none. You can do that. You can be 100% tax-free if you buy the right real estate and you follow the IRS's rules. And that's what I pride myself on, is teaching everyday taxpayers how to invest in real estate, but use the real estate to offset their W-2 and 1099 income, so they're taking home 100% of their paychecks. Not 20%, not 50%, not 60%, 100%.
So in that case, say if I went ahead and I bought a property out in Texas.
Yeah.
And would I still keep it under my LLC in California, or would it be more beneficial, I guess, or tax friendly for me to actually open up a separate LLC for the state of either Florida or Texas?
Okay, so
depending on where I invested it.
Yeah, and I'm glad you asked this. So since this is a passive investment, it's not an active investment, meaning it's not tied to what you're actively doing.
Yeah.
This is a situation where we're not going to pay the taxes here in California, and why we should set up an LLC in Texas, since that's what your business is, right? Although Karlton lives in California and he has real estate in Texas, I'm not going to let my California LLC own my Texas rental property. I will set up a Texas rental property so that way I'm not considered foreign to my own state from a filing requirement perspective. And most taxpayers will set up LLCs where they own their investment properties, and then they'll look to set up a parent company, like in some of the states that you mentioned earlier, Wyoming, Nevada, Delaware.
Okay, so like say if I went ahead and I own the property, and this is like a step forward. I own the property, I open up the LLC, let's just stick to Texas, right? From there, I have my own personal car over here in California. Say if I want to pay less and like just overall, like, I guess insurance and, just my annual registration. A lot of people, you see a person with like a brand new Rolls Royce Cullinan, right? And it'd be like Montana. So like, would I be able to then transfer, say, my personal car over to my LLC over in Texas to get a Texas license plate, get it registered out in Texas, so that way my insurance could go cheaper? Like, you get what I'm trying to get to? Like, how would you go about transferring over a vehicle over here in California, regardless of whether it's an exotic car or just like your average car, over to, obviously save a little bit more money.
Yeah. So I think you're referring to sales tax, and most people will buy properties. Most people will buy vehicles through a Montana LLC, because if you purchase a vehicle through a Montana LLC, Montana has specific laws for LLCs that state that you don't have to pay sales tax on the purchase of an asset through an LLC. So if I buy a vehicle such as a Cullinan and it's over 6,000 pounds, the IRS will allow me to write off the entire purchase price of the Cullinan at 80% this year. It was 100% last year. Mm-hmm. And I could save money on the sales tax if I purchased it through a Montana LLC. But now I have to take it upon myself to register the vehicle in Montana, get Montana license plates. If I ship the vehicle from Montana to California and I'm driving on the freeway or I get pulled over by police, I could get a ticket. I could end up experiencing a situation where they will make me register that vehicle in California and pay a fine. So you have to be very careful when you're buying vehicles through Montana and then shipping them over to another state. The intention is you're probably not going to be driving this exotic car too often. Mm-hmm. So the goal is you probably won't run into police too often. And believe you me, guys, I have tons of clients that do this. From a taxation perspective, it won't save you any money on taxes, because it comes back to, are you utilizing the vehicle for more than 50% business? Yes. And if you tell me, hey, Karlton, I'm living in California, but I have a property in Texas, how are you going to justify to me that you're using that vehicle for more than 50% business if your business is in Texas, aka the rental income that you're earning? Maybe you're managing the property from the convenience of your home here in California, but can you justify using that vehicle for more than 50% from your home here in California? Are you driving all the way to Texas in a Rolls-Royce Cullinan? Yeah. Probably not. Mm-hmm. So that's when we start to break down that whole deduction, and the IRS is like, maybe we'll throw this one out.
So what about in the case of like, okay, so you want to buy the vehicle from for your LLC in Montana, right? Mm-hmm. Or Wyoming or wherever. Mm-hmm. But then just to avoid the sales tax.
Right.
But then you register it in California.
Yeah.
Is that just a smarter way to go about it?
Oh yeah, you could 100% do that after.
Flip and go. Yeah,
mm-hmm.
yeah.
Now, a lot of taxpayers get confused in regards to the vehicle deduction. So last year, the vehicle deduction was 100% if the vehicle weighed over 6,000 pounds. But it's not just the vehicle weighing over 6,000 pounds. The IRS has this term called gross vehicle weight ratio. And certain cars don't technically weigh over 6,000 pounds, but their gross vehicle weight ratio weighs over 6,000 pounds. And what comes into the gross vehicle weight ratio is how much is the car when weighing when all passengers are in, or when it's fully loaded, or next to a curb, or in a certain zone.
What about if it's like trailing if it has a trailer attached?
Or if it has a trailer attached. So these different circumstances go into the gross vehicle weight ratio, and this is a statistic that is developed when the manufacturers make the car. So from taxation purposes, we look online before we write off the vehicle on your tax returns is, what is the gross vehicle weight ratio of your Mercedes XLE 350 or whatever it might be?